Hey guys, I hope you all are doing well. So this is going to be our session for the SBR, where what I would actually be doing is that I will be doing the past examination papers with you people so that you people could have an idea that how exactly these papers need to be attempted. So I'm just going to start sharing the screen and what happens is if I say, let's say, how do you go about it? The way I go about it is this way. I go onto the ACCA website, I click on the past examination papers. And when I click on past examination paper, there is this ACCA qualification that you go on to. Under the ACCA qualification, you click on the strategic business reporting. Under the strategic business reporting, what happens is that you click on past exam questions and question practice, and then you click on this login to practice platform. So what do? You click onto this login to practice platform. On the practice platform, what do you need to do? You need to actually log into the ACCA platform. You need to log into the ACCA platform. Now, so you would then click on this browse. You would click on this browse available examinations. Okay, so you've now clicked on this SBR and then there is this international variant. And then I would just click on this pass examination because okay, so I'm now actually having these past examination papers in front of me. So what I could probably do is that I could just go on to do the latest examination question. So I'll just go on to do this. I'll assign these examinations to myself. So I have actually assigned all the available examinations to myself. Now, what's the next step? The next step is going to be, I will click on view assignments. What will I do? I will click on view assignments. I want to do the latest exam paper with you people. So I would just click on the latest exam paper first. So the latest exam paper that have actually been assigned is basically going to be this SBR March, June 2025. You click on the start button and you have this start button. So you have the examination in front of you. What I'm going to do is that I'm going to do the actual examination paper with you people. Okay, I'll just go on the full screen window. So it says if you're ready to begin the examination, yes, we are ready to begin the examination. Let's begin now. So there is this question, and this is a typical question number one that you get in the examination, and it's an actual past paper. So it says ICAP company is the parent company of a group. It prepares financial statement using the IFRS. The financial year end, the financial year end is 31st December. The following exhibits available on the left-hand side of the screen provide information relevant to the question. So what are the requirements to this question? The requirements to this question is using exhibit number one, explain with calculations Using exhibit number 1, explain with calculations and in accordance with IFRS accounting standard, how to correct accounting treatment of the investment in Brine in the consolidated financials for the year ended 31st December 7. Your answer should include a revised calculation of the goodwill arising on acquisition of Brine company. Second, using exhibit 2, explain with calculation in accordance with IAS 19 how to account for the defined benefit plan in the consolidated financial statements. Using exhibit 1 and 2 and your previous answer, adjust the pre-populated spreadsheet. So it's a 30-mark question. And on this 30-mark question, what we need to do is that we need to do several adjustments, including the adjustment to the existing financial statements. Now, first of all, we talk about this acquisition. We talk about this acquisition. So can you just go through it? Then I'm going to start discussing with you people. Can you just quickly go through it? Those of you who have joined in a bit late, I'm actually doing this March, June 2025 examination paper. And I'm right now on to question number 1. So can you just read through this, please? Can you just read through this? Yeah, just read through it and then we start discussing. Okay, let's begin. So it says on 1st January. Now, first of all, which financial year we are talking about? We are talking about 31st December X7. So it says on 1st January X7, ICAP paid $4.3 million to acquire 25% of the 5 million equity shares of Brine. This shareholding enabled ICAP to exercise significant influence over Brine's financial and operating policy decisions. ICAP recorded this investment at cost within financial asset in the draft consolidated financial statements, and no further entries have been recognized. On 31st December, ICAP acquired a further 45% of the Brine's equity shares and gained control. Consideration comprised cash of this much and $1 million $1 shares which had fair value of this much. On 31st December 7, Brian's quoted share price was this much. The fair value of Brian's identifiable net assets on 31st December 7 was this much, which was the same as the carrying amount in its individual financial statement. In the year ended 31st December 7, Brian reported a profit of $2 million and no other comprehensive income. In the draft consolidated statements for the year ended 31st December 7, Brian was treated as a subsidiary and accounted for using the acquisition method. In the draft consolidated SOFP, the NCI was measured at its proportionate share of the fair value of identifiable net assets. How the policy of the group is to measure the NCI at acquisition at its fair value. Goodwill in draft consolidated SOFP was calculated as follows: cost of this, NCI at acquisition this, fair value of net asset this. No accounting entries have been recognized in respect of the issue of ICAP's equity shares. Now, this is one of those transactions that has not been appropriately accounted for. So a transaction that has not been appropriately accounted for. So let's just try to see what is the examiner expecting us to do. Let's just try to see what is the examiner expecting us to do. Now see. So the requirement of the question is, using exhibit number 1, explain with calculation and in accordance with the IFRS how to correct the accounting treatment of investment in Brine in the consolidated financial statement for the year ended 31st December X7. Your answer should include the revised calculation of goodwill on the acquisition. So what I'll just do is that I'll try doing the answer on the spreadsheet so that I can share the answer with you people too later on. So March, June 2025. Now see, on 1st January, ICAP paid $4.3 million to acquire 25% of the 5 million shares of Brine. This holding enabled GAP to exercise significant influence over Brine's financial and operating policy. ICAP recorded this investment in Brine at cost within the financial asset and draft consolidated SOFP, and no further entries have been recognized. Now see, since ICAP got significant influence over Brine, therefore Brine is an associate and should be accounted for using equity method of accounting in the consolidated financial statements. The statement of comprehensive income should have included the share of profit from Brian, the associate, during the year, whereas the statement of financial position requires investment in associate to be shown as determined using equity method of accounting. So that's what you have to do, right? That's what you have to do. Now what next is there? It says on 31st December, ICAP acquired further 45% and gained control. Consideration comprised cash of this, and 1 million shares of this, which had this. Now see, with respect to the acquisition, the additional 45% shareholding, ICAP now starts controlling Brian as it has got majority shares, and Brian, and there should be a deemed disposal of the associate at the date of further acquisition. The goodwill for the purposes of the goodwill calculation, the cost of investment shall comprise. For the purposes of goodwill calculation, the cost of investment shall comprise for the purposes of goodwill calculation, the cost of investment shall comprise the fair value of the existing shareholding and the cost of the additional shareholding. The cost of investment shall include the fair value of all the consideration paid / transferred. So what is actually going to happen is that cost for further acquisition will be cash paid. Cash paid, how much? 15.1 million. I just need to recheck. How has he done the accounting? Is he done the accounting? Yeah, he's done the accounting. in terms of millions. Because had he done the accounting in terms of thousands, I would have worked in terms of right. So cash paid is 15.1 million and 1 million of ICAP's $1 equity share, which had a fair value of 3.2 each. Fair value of the shares issued is gonna be what? Is gonna be 3.2 into 1. Is gonna be 3.2 into 1. Now, on 31st December X7, Brian quoted share price was 5.7. The fair value of Brian's identifiable net asset was 14 million, which was the same as the carrying amount in its individual financial statement. Brian reported a profit of 2 million and no other comprehensive income. Now, this is cost of further acquisition. The existing interest of 25% is to be remeasured to fair value. The existing interest of 25% is to be remeasured to fair value with gains slash loss to be recognized in the P&L. So cost of existing interest. Cost of existing interest was basically and fair value of existing interest. Each share of Brian is 5.7. 5.7 multiplied by 25% multiplied by 5 million. 7.125. So gain on investment. Gain on existing interest. So this is a gain on existing interest. It's a gain on existing interest. Now what next is gonna be there? Right now, what else is there? So if I try to calculate the goodwill calculation, I would say fair value of existing interest is this. Cost of additional acquisition is this. Then fair value of NCI. So basically each of the share 25% was the original shareholding, plus you acquired 45% more shareholding. So 100% minus 25% plus 45%. This is multiplied by what is the value of Brian's share? 5.7. So hence resultingly, the fair value of the NCI is 1.71. 8.55 is the fair value of the NCI, less fair value of net assets. So the net assets that are there are basically fair value of identifiable net assets at 31st December 7 was 14 million, which was the same as the carrying amount in its individual financial statement. Brian reported a profit of 2 million and no other comprehensive income. So what actually happens is 14 million. Hence we have the goodwill at acquisition. Now, for the investment in associate, cost of investment that was there was originally 4.3. Share of post acquisition profits. So 2 million multiplied by 25%. So 4 plus 0.5, 4.8. So technically, when we dispose of, it has to be deemed as, let's say, investment the fair value of investment on the date of further acquisition is 7.125. Gain on deemed disposal is this minus this. So anyways, we know what the goodwill is gonna be. We know what the goodwill is gonna be, right? I mean, we know what the goodwill is gonna be. Yeah, all good. Let me know if you will understand this, please. Yeah, if there is any question, let me know on this, please. Yeah, all good. No response, no response. Hello, no response from you people. Okay. Um, let's move a bit forward and let's take things further. So we have done this one part. Now defined benefit plan. And what do you have to do with respect to this defined benefit plan? The requirement is using Exhibit 2, explain with calculations and in accordance with IS 19 employee benefits, how to account for the defined benefit plan in the consolidated financial statements. So this is what you have to do. Defined benefit plan. Okay, can you just go through it, please? Okay, let's see. EGAP has a defined benefit employees reported as non-current liability in the consolidated statement of financial position. So what do they have? Okay, now let's see. So basically, it says that 7 million was reported as a non-current liability in the consolidated financial statement of financial position. Then it says on 1st April X7, the plan was amended to provide additional benefits with effect from that date. The present value of additional benefits on 1st April 7 was $4.2 million. After the amendment, the plan was determined to have a net obligation of 12.19 million. Because of the improvement in terms, the monthly service cost changed from 0.3 million before 1st April X7 to 0.35 million per month after 1st April X7. Interest rate on high quality corporate bond was 5% on 1st January 7, but this rose to 6% on 1st April X7. At 31st, the actuary valued the net obligation at $10 million. Only accounting entry posted in respect of the above was to recognize credit contribution of 4.1 million paid to pension plan in the consolidated statement of profit or loss. Now, what do we need to do? What do we need to do in respect of this specific transaction? So requirement is using exhibit to explain with calculations in accordance with IAS 19 how to account for the transaction under the IAS 19 employee benefits in the consolidated finances. So opening defined benefit liability is 7 million. Opening defined benefit liability is 7 million. Now what actually happens is on 1st April, the plan was amended to provide additional benefits with effect from that date. Present value of additional benefit was 4.2 million. After the amendment, the plan was determined to have a net obligation of 12.19 million because of the improvement in the terms of the plan and so and so, so and so, so and so. Now see, what actually happens is that we would say that interest at the rate of 5%. So I will actually calculate this interest for 3 months. 5% into 3/12. Then what actually happens is current service cost is going to be 0.3 into 3 plus 0.35 into 9. So resultingly, what is actually going to happen? Try understanding this thing. Now there is this past service cost, which is 4.2 million. The interest at the rate of 6%. So since past service costs arise during the year, so 7 plus 4.2. This is multiplied by 6%, multiplied 9/12. So 0.504. 0.504. Okay. So this is what we have. So interest and this, and then what happens is that contributions paid. The contributions paid are gonna be what? Mm, 4.1 million. Closing defined benefit liability is 10 million. So what is actually gonna happen is this is gonna go to P&L. This is gonna go to P&L. This is gonna go to P&L. This is P&L. This is OCI. This is balance sheet. Yeah, all good here. Hello, you people don't respond back. Hello. Okay, now what we need to do is that we need to say that, okay, the improvements to the plan that lead to additional benefits being paid is the past service cost, and it is to be recognized in the income statement. Additionally, the unwinding of discount is to be booked for the first 3 months at 5% and at 6% for the later 9 months. It is assumed the contributions paid into the plan are recorded as reduction to the defined benefit liability. The difference between what the plan was expected to be and what it turned out to be to be is a remeasurement gain and is to be recognized in the OCI. Yeah, I can draw the journal entry, don't worry. Okay. The correcting entry will be as under. What have they done? How have they recorded expense? They've just recorded an expense in the P&L. Okay, so we're just gonna correct it and I've recorded 6 this other expenses slash admin cost is debited by 4.15 because 4.15 is the net of like 4.05 is one expense, 4.2 is one expense, contributions paid of 4.15. The other comprehensive income is gonna be credited by 1.74. Defined benefit liability is gonna be credited by 3 million. So this is what the correcting journal is going to be. Correcting journal is going to be this. So repeat, the correcting journal is going to be this. Now let's move a bit forward and let's talk further using exhibit 1 and 2 and your previous answer. Adjust the pre-populated spreadsheet response option. So what do you have to do? You have to actually adjust the consolidated statement of finance the adjustments accordingly. So for example, what actually happens is that if we talk about the goodwill calculation, we determined the goodwill to be 19.975 and he determined the goodwill to be 5.3. He determined the goodwill to be 5.3. So what is probably going to happen is that equals to 19.975 minus 5.3. This is the adjustment that you are probably going to put in. So you would say adjustment 1, you would say adjustment 2, so on and so forth, and then adjustment 3, and then you will actually be getting a group accounts. You'll actually be getting a group account, right? So this is what you are going to be getting. I mean, this is what you are going to be getting. Okay, because there could be multiple adjustment, like maybe let's say adjustment 1, adjustment 2, adjustment 3. So there could be multiple adjustment, and then you could just sum up all of these to get the final amount that is to be recorded in the group. So that's what I'm suggesting, right? So what could possibly be done is that there could be multiple adjustments. So you just create columns and you just keep on going about it. That what exactly and how exactly do we need to do this? Okay, let's move. Yeah, I'll just share it. Don't worry, Micah Koto. Okay, now let's move on. Let's try doing the next question, which is question number 2. And the question number 2 is basically by float company operates in the football industry. It prepares its financial using IFRS accounting standards. Financial year end is this. Requirement is requirement is in accordance with IFRS 9 financial instrument. Discuss the accounting treatment of transaction in exhibit number 1 in the financial statement. Exhibit 2 discuss the ethical issues raised by the scenario and the actions that Miss Heiss should take. So can you just go about it? Can you just go about it doing this specific area? That what do we have to do with respect to it? The requirement is using IFRS 9 or in accordance with IFRS 9. What is it that we have to do? What is it that we have to do? We have to actually uh, apply this requirement, right? So can you give it a try? Okay, try going through it and then I'm gonna start discussing. Okay, please let me know. I'll just start off in 1 minute now. Okay, now Ply Float acquired 5% of the equity capital of Valletta some years ago, but did not make an irrevocable election at the initial recognition date to measure the investment at fair value through other comprehensive income. Subsequently, they experienced significant operating losses and Bifloat provided a substantial loan to Valletta on non-commercial terms. At 1st January 7, Bifloat still held the 5% equity capital of Valletta, in addition to having a significant loan receivable which was correctly measured and amortized. At 31st October 7, Bifloat agreed to write off half of its loan to Valletta in exchange for further 10% of the equity shares of Valletta. The fair value of the shares received in exchange was considerably lower than the carrying amount of the loan receivable. On 31st December, Valletta was unable to repay the interest falling due on the remaining loan. Now, it says in accordance with IFRS 9, discuss the accounting treatment of the transaction in exhibit number 1. Now, what do you think should be the accounting for this? What do you think should be the accounting for this? Yeah, hello. What do you people think should be the accounting for this? Okay. Fair value ECL. Okay, lovely. Now see, what happens is that they did not make an irrevocable election. They did not make an irrevocable election. They acquired some years ago to measure the investment at fair value through other comprehensive income. They did not make. Subsequently, they experienced significant difficulties, so and so, so on. So now see, what happens is that what do we need to do? Okay, now let's see. So you need to understand this thing that basically question number two. Question number two, the requirement is number one. So you're simply gonna do it this way. You're gonna say that, okay, the investment can be measured. The investment was not classified as at fair value through other comprehensive income. This means that it will be measured using fair value with gains and losses recognized in the income statement. The So the investment was not classified as at fair value through other comprehensive income. This means that it will be measured using fair value with gains and losses recognized in the income statement. Um, with respect to the loan extended, the loan is to be measured at amortized cost and is correctly measured at the amortized cost. The non-payment of the loan and the offer to since the buy float since Valletta is struggling to make payment since Valletta is struggling to make payment since Valletta is struggling to make payment, this is an indicator of the of impairment. The conversion to the equity share is to be recorded at the fair value of the equity instruments, and the remaining the conversion to the equity share is to be recorded at fair value of the equity instruments, and the remaining amount is to be recognized on the basis of loss allowance. However, the default in the interest payment is considered to be a loss event and requires the write-off of the loan receivable. The write-off should lead to reduction in the carrying amount of the loan asset and B of the interest receivable and should be recorded in the income statement. Right, all good. Now let's move. Let's move a bit forward and let's try understanding further. What's the next part? The next part is using exhibit number 2, discuss the ethical issues raised by the scenario and the actions HICE should take to resolve these. Now let's see. So ethical issues. Can you try to go through it? Yeah, please try going through it. Identify the ethical issues which you can through the scenario. Okay, let's see. Bifloat has a football team in the top division of National League. The board of Bifloat is dissatisfied with the football team's recent performance and has set out plans to borrow $50 million from the bank to spend on new players and facilities. So what have they done? They have actually borrowed 50 million from the bank to spend on new players and facilities. The new chief accountant, Miss Hayes, is ACCA qualified. She initially applied for a permanent position but was appointed on a 9-month temporary contract, which may be for a permanent position but was appointed on a 9-month temporary contract, which may be extended based on her performance. Based on her performance. She reports to the finance director. She reports to the finance director. Under pressure from the FD, Ms. Hayes has produced an optimistic analysis indicating that 50 million investment will be worthwhile and will achieve the board's objectives. Ms. Hayes is aware from the recent press reports that similar football teams have had to spend significantly more than $50 million to achieve similar results. The analysis has not yet been sent to the bank. Ms. Hayes is concerned that Bifloat will face a cash flow shortage within 12 months of the reporting date. So Hayes is concerned that Bifloat will face a cash flow shortage within 12 months of the reporting date. This is dependent on the club's future performance, its ability to renegotiate its overdraft facility, and the company's relationship with key shareholders. The board has told Ms. Hayes that a going concern assessment is not required and that she is to make no reference to any financial difficulties in Bifloat's financial statement. Most members of Bifloat board, including the finance director, are ex-professional football players. Ms. Hayes has never played football professionally and believes that as a result, the board does not respect her opinion. Now, what is the requirement to the question? Again, discuss the ethical issues faced by the scenario, raised by the scenario and the actions that Ms. Hayes should take to resolve these. Now let's discuss. It says Bifloat has a football team in the top division of National League. The board of Bifloat is dissatisfied with the football team's recent performance and has set out plans to borrow 50 million from the bank to spend on new players. New chief accountant Ms. Hayes is the ACCA qualified. She initially applied for permanent position but was appointed on a 9-month temporary contract, which may be extended based on her performance. She reports to finance director. Under pressure from FD, Hayes has produced an optimistic analysis. Now, optimistic analysis has been produced. Optimistic analysis has been produced by Ms. Hayes. This was under pressure from the finance director. This was under pressure from the finance director. Uh, okay. The available valid information has not been shared with the bank, that other clubs required more funds. Aware of the cash flow shortage in next 12 months. Okay. Board has instructed Miss Hayes not to report any financial difficulties that are being faced. Miss Hayes does not have a football club experience. Now see, I'm not I'm not gonna write down the answer like this. I'm just identifying few things. And now I'm gonna tell you that if you come across a ethics scenario, how exactly do you have to answer the ethics scenario? How exactly do you have to answer the ethics scenario? So you have to answer the ethics scenario in this manner. You have to answer the ethics scenario in this manner. What do you have to do? First of all, you have to say that you have to identify what are the ethical issues. Fundamental ethical principles. So when I talk about fundamental ethical principles, they are integrity, objectivity, professional competence and due care, confidentiality, and then professional behavior. The ethical threats could be self-interest, self-review, intimidation, familiarity, and advocacy. So now, what is actually going to be an issue? So I would say that Miss Hayes the exhibit demonstrates that there are several ethical issues that arise slash exist from the actions and behavior of Miss Hayes. Firstly, the fact that Miss Hayes is aware that $50 million will not be sufficient, plus the business will have cash flow issues in the upcoming time period. This all suggests that this all suggests that her behavior for the reporting lacks integrity. Additionally, she is not being offered the permanent position, but rather temporary position, and is being forced to do better reporting as she has a self-interest threat to secure her employment, plus and additionally also is facing intimidation from her senior. The reporting done by Ms. Hayes, despite knowing that it is inappropriate, is a reflective of lack of professional behavior on her part. Is a lack of professional behavior on her part. Right? Okay. Despite knowing it is a probably lacks professional behavior on her part. Now, what else is the requirement? Uh, Miss Hayes should immediately take an action to update the report to reflect about the funds being utilized and related to the I'm sorry, my internet got a bit disturbed. Now, in case if the management is unwilling to let Hayes report appropriately, then Miss Hayes should consider resigning from the role. Yeah, all good here. Yeah, all good here. Yeah, all good. Let me know all good, please. Anything else that you want to add up? Okay, now let's see. So we are done with this second question also. Let's move on to the third question now. And the third question actually has got three requirements. It says using exhibit number 1 and in accordance with IFRS 15 revenue from contract with customer, discuss accounting implications of the two contract modification over the contract terms. So first of all, let's just go through the exhibit number 1. First of all, let's just go through exhibit number 1. Now, let's just see. So if we talk about this contracts, so what is it that we have to do? Try understanding this. Can you just go through it and can you just see that what needs to be done on this? Yeah, let me know what do you think should be the answer to this? Okay, on 1st January 2007, Ments agreed to contracts with two different customers. Under both the contract, Ments agreed to provide information technology services to each customer for 4 years. When initially agreed, each contract contained a single performance obligation. So each contract contained a single performance obligation. On 1st January X7, the contract price was agreed at 60,000 per year. It's a 3-year contract, right? 4-year contract. The contract included a clause allowing the customer to cancel the fourth and final year of the contract. Fourth and final year of the contract, paying a total penalty of 10,000. This decision had to be made by 31st December 7. On 31st December, the customer informed Ments of its decision to cancel the final year of the contract and it paid $10,000 penalty on the same date. Now, so what is actually going to happen is that just try understanding this thing. If there is a single performance obligation, the entire transaction price is to be allocated to that single performance obligation. Since the penalty, it is assumed that the revenue can be recognized over the period of time as the amount is recoverable from the customer. Since the penalty belongs to a 4-year contract, therefore, this penalty of $10,000 is to be recognized over the 4-year period on a straight line over the 3-year period on a straight line basis and be added to the total contract price. That is the total contract price to be considered as 60,000 times 3 plus 10,000 is equivalent to 190,000 divided by 3, and it is to be spread over the 3-year period. Contract 2 on 1st January, the contract price was agreed at 72,000 per year. At 31st December, mentioned customer agreed to change the contract to add an additional service to the contract. The service represented a separate performance obligation. As part of the change, customer agreed to pay a total contract modification fee of 2,500. In addition, the contract payments will increase from this per year from 1st January X8. The increase in the annual payments was based upon the normal selling price of the additional service. So what happens is that for contract 2, the additional service is to be provided for the subsequent years. The revenue to be allocated to the additional services shall be 90,000 minus 72,000 is equivalent to 18,000 multiplied by 2 multiplied by 3 plus 2,500 and is to be spread over the remaining period of the 3 years. So this is how you have to record it. This is how you have to record. Then you have got question number 4. In fact, question number 3, next part 2. It is actually about the lease agreement. Can you give it a try, please? What's the update? What's the update? Yeah, any update? Have you been able to do this one, please? Okay, on 1st January, Ment's a lessee entered into a 2-year lease for its head office. The annual lease payments were agreed at $500,000, payable on 31st December each year. The implicit interest in the lease was not easily determined, but Ment's incremental borrowing rate was 5% per year on 1st January 7, On 1st January 7, the present value of lease payment made was correctly calculated as this. On 31st December 7, after the lease payment was made, both parties agreed to extend the lease term by additional 1 year. Annual lease payments remained at 500,000 per year on 31st December 7. Meant incremental borrowing rate had increased from this to this. Now see what happens is that what do you need to do? So uh, with respect to the lease modification, the present value of the lease payments are to be determined, and the present value of the lease payments to be determined and compared with the existing carrying amount. The difference is to be adjusted to the lease obligation. So opening lease obligation is 930,000. Effective, finance cost at the rate of 5%. Rentals 500,000. The carrying amount at 31st December X7 is this, is 476,500. Now, the revised carrying amount is as per note number 1. So note number 1, what are we going to do? We're going to say cash flows, discount factor, present value. Year cash flow year 1, 2. The cash flow, the year 1 is going to be 500,000. 500,000. This is 1.06 power minus this and this. Hence, the sum of this is this. So the carrying amount is this. The difference is, so what do you have to do? You have to add 440, 196 to right of use and to lease obligation. That's what you have to do. That's what you have to. All good here? Yeah, all good here, please. Part 2, all good here? Okay, now final adjustment, and that is actually about the bond. Give it a try, please. The bonds, give it a try. Okay, let's see. It says MENTS has a functional currency of the dollars. On 1st January X7, MENTS purchased a bond for its fair value of 2.7 million dinars. The bond does not pay annual interest. However, MENTS will be repaid its investment plus a significant premium in 4 years' time in dinars. The effective interest rate is 6%, which is in line with the market rate for the bond with this level of risk. MENTS intends to hold the bond until maturity. Exchange rates for the year ended 31st December 7 were as follows, so and so, so and so, so and so. Now, what do we have to do? The requirement of this question is that using Exhibit 3 in accordance with the IFRS accounting standard, explain with calculations how the bond should be accounted for in the financial statements for the year ended so and so, so and so. Now see. Now let's see. So you are actually going to do the accounting in this manner that first of all, at 1st January X7, 2.7 million dinar. The exchange rate 1.1. Amount in dollars. Then there is this finance cost, 6%. Is this into 6%? 1.3. Exchange gain slash loss. Closing is basically this plus this. So there is actually a loss on this bond. So technically what you have to do, financial asset is credited and P&L is debited. Right? This is how it is gonna be. This is how it is gonna be. So do you understand this, right? So this is basically how we need to account for all of this. So that was basically the three questions of the examination March June 2020-25. I hope that you people would have gained insights into how to actually attempt the questions, how to handle these scenarios. What I'll be doing is that I'll be sharing the recording with you people so that you people could actually go about it and you people could actually go through them. So that's it for today. And we'll meet up in the next class and we'll take things forward, right? So thank you guys. Thank you for being here. Thank you for attending. See you all.